Welcome everyone to a very special edition of CRE Fast Five. I am Carly Iacono, a Senior Vice President at CBRE and a National Net Lease Investment Sales Advisor. I am very pleased to be joined by Kirsten Jordan of Million Dollar Listing New York and a top advisor at Douglas Elliman Real Estate in New York City. Welcome, Kirsten. How are you today?
Thank you so much for having me. I'm great. This is so fun to connect and just talk about what we're both doing and how different, are the asset classes are that we are specializing in.
Absolutely. So to everyone listening, we appreciate you joining us. We thought this would be a lot of fun because we are both in the New York Metro and we have a lot of overlapping clients, but the asset types that we both specialize and excel in are vastly different. So we want to take a minute and kind of start with an overview of the New York market, kind of where we are. It's been a wild few years. Kirsten, why don't you let us know what's going on, big picture with residential in New York City right now?
Well, it's really interesting because we have all kinds of very conflicting headlines that we've been seeing over the last year. When we were in the darkest days of COVID and quarantine, we had, the amount of transactions slowed dramatically. And for us, when the gears lock of the mechanism of New York and there's no longer transactions at any level, that affects pricing dramatically because at some point, sellers have to reprice and the market has to correct in order to drive that momentum again. So for what happened with residential real estate was we did see a pricing decline during that, specific, 4 or 5 month period. And then as the market reawakened and reopened, come end of June, beginning of July of 2020, we saw this slow restart to the market. And then it wasn't until about the fall that we started to see the activity just spike dramatically. And what that did was anything that was a really, really good opportunity started to absorb very quickly. Anything that was new development that was showing true value really also absorbed. And now we're moving into an inventory scarcity in the prime neighborhoods, especially in the luxury sector. And the other areas where there are still incredible opportunities tend to be neighborhoods that are a little bit more off the beaten path of being the ultra prime. So, this is that Kips Bay, Murray Hill, those kinds of neighborhoods, the far West Chelsea. That's where we're seeing some opportunities still, Hudson Yards as well. Those are areas where we're seeing there are some real opportunities for buyers who are interested. Shadow inventory, also the same thing with the financial district, areas where there's, inventory where you can still find some kind of a deal. But then as you go into the West Village and Tribeca, Upper East Side, the deals are really gone, at pretty much all price points, unless they need a tremendous amount of TLC, love and care and renovation, or have other hair on the deal. So, what we're seeing right now that's been incredible is even throughout the summer, we're still seeing a very high volume of signed contracts week over week. And we're seeing demand and we haven't even seen the international market really reopen because the states aren't open yet for them to come back in person and buy these assets. So that's what we're seeing overall in the macro to micro level, that, as residential assets vary greatly because of the fact that they're very personal in a lot of ways. And so your specific asset might be experiencing something different than what I'm talking about, but overall, this is kind of the macro of what we're seeing.
I think it's so interesting how disparate the headlines are from reality. And I see this with what I do, which I'll touch on in a moment. The headlines have been New York is dead for the last year and a half. And I am constantly in the market saying, no, it's not. There's so much happening. There's tremendous demand. Everyone's flooding back. So to address that directly, are you finding that the people who left New York City are the ones now coming back and saying, maybe I don't want to live in Florida year round after all? Or are you seeing new people enter the market who maybe were priced out before or think there's opportunity and are kind of putting their toe in and testing it? Who is your main buyer pool right now?
There are a tremendous amount of people coming back to the city that are not thrilled with having lived in the suburbs. There are people testing out the Florida market still and trying to figure out if that's been completely topped out in the sense that if it's like really, really reached the peak. And because of what's happened with that market, people are afraid to get in because they just feel like it's just very, very inflated. And so we have those buyers. And then we have the people exactly like you're saying, where they say, hey, I haven't lived in New York in 20 years. I heard the market's soft. I'd love to buy a 1-bedroom in the West Village, which I'm like, I don't know if you're going to get such a great deal right now.
Yeah.
But so I would say they're really several different groups of buyers, and none of them are really overwhelmingly the ones I'm seeing more than others. There are still people who are saying, I have deep pockets and I want to maybe hold on to my asset in New York City because if I sell what I have now, I don't know if I'm going to be able to re-enter, which if you're bullish on the New York City real estate market, makes sense, because you're worried that, to replace the home that you have with the friction costs, which can be as much as 10% on the way out, could be something difficult to do, because then you don't know when you're going to find that replacement asset and what price point that's going to be.
So I want to shift a little bit to the investment mindset, kind of compare and contrast our different asset classes, but give me the landscape of your client base. Are most people buying as a primary residence, or do you see investors coming in and buying condos or multifamily buildings to rent out more? What's the breakdown?
I have investors in some cases that come in to buy residential assets and buy them as investment. I do work mostly with residential primary user clients. So I would call those, your end user client that is buying for their own personal use, because with residential, that's always kind of the area where it's the easiest to say, at some level, it's important for me to have this luxury of owning my home and being able to make those modifications and live in it and know that this is where we're going to be. With the residential investment purchaser, a lot of those are either 1031 exchange purchasers because of the fact that they've had a gain and so they've decided to reinvest, or they are Europeans who, or from cultures where real estate is king. And this idea that by owning what they call in Italian, they call it like mattone, which is brick, by owning actual physical assets, long-term, they believe in those assets. And the yield, as we've discussed, can be lower and can have vacancy over the years, which then can affect the overall yield, in a shorter term basis. But they love this idea of the longer term appreciation, it being a very residential asset, and that they know that at some point, if they needed to sell it, there's going to be end users who'd be interested in purchasing it. So, we do have those investment buyers. And right now we're finding it increasingly difficult because of the fact that the rental market has really, really risen, the luxury rental market. And so that's put buyers that were in the should I buy or should I rent phase into the buying category and made them have to make some decisions. So it's right now, it's really difficult to find product for investment that is in the prime neighborhoods. You really have to push yourself out into those neighborhoods where there might be opportunities and the yields might not be there yet, but that you believe in those yields because you're going to get a good price for the asset.
And I think that's one of the main differences between what we do. And I want to just back up for a moment and share with everyone listening a little bit about net lease investing, because perhaps some of our listeners are only familiar with the residential market. So I lead a team that sells net lease properties nationally. We happen to be based in the New York Metro, but we do operate in all 50 states. Now with net lease investing, you have a national tenant in most cases under a very long-term lease, and that lease is locked in. For example, we just brought to market a CVS 30 minutes right outside of New York City with a 25-year guaranteed base term and another 40 years of options. So an investor would look at that asset and say, I understand what my income will be potentially for the next 65 plus years. So they're really buying that for the security, right, of their capital, and less about the fluctuations and upside in return. It's definitely a stability play. So what I'm hearing from you is that the investors might love the market, but that yield, that stability of return has been the challenge. Would you say that's true? Yeah.
Stability, as many people may know, across the United States, it's rare to have residential leases that are longer than 2 years. People don't do that. And so, and Americans are transient. they move. And so this is when you're dealing with residential leasing and these residential investment opportunities, you are inevitably looking at periodic vacancy. And that's the absolute opposite of what you are presenting as an opportunity.
And do you find that most investors for residential price in that vacancy appropriately? And the reason I ask, we have clients come to us who are transitioning out of multifamily apartment buildings, less condos, but more apartment buildings. And one of the main reasons, number one, is the management responsibilities that they kind of underestimated, but also their net operating income is not always what they think because of vacancy, that maybe they put a 3% vacancy factor on, and it's really a lot higher than that, or it takes longer to replace the tenants when those leases are rolling over. So do you find that people are properly, estimating the vacancy, or is that an area where they maybe get hung up long-term?
It really depends on the investor, because many investors are okay with seeing fluctuations in rent as long as there's no vacancy. And then you have investors that say, I won't lease under a certain threshold and I'm willing to sit vacant until I find that person. And so that's where we see the biggest discrepancy with people budgeting for vacancy, because if you are hung up on your number and we have a moment like we had, towards the end of 2020, beginning of 2021, then you might sit for 6 months with an asset, because the fact that we did have a really, really tough time for about 6 months in the luxury rental market. And the other thing that happens, which is rarely spoken about, but does happen infrequently, is damages to the residential asset, which then mean you have to put a lot of investment into repairs between tenants. So this is something that, you don't experience on your end, but the landlord is responsible for making sure that the asset then is ready, the apartment's ready, or any sort of, in multifamily, all those apartments are ready for the next tenant when there is vacancy. And that's a cost that's associated with the vacancy as well. So you deal with this kind of double whammy, if you will. And that is hard to budget for, because if you have a long-term tenant, I have one residential apartment in Tribeca. We've had the same tenant in place for 5 or 6 years. They're very, very happy there, and they're not going anywhere. And then, we have another apartment that just hasn't had the best of luck and continues to have these 6 to 12 month renters in place. And that's not easy. Interesting.
Yeah, it's a very different investment thesis, but both have long-term value, which I love. So maybe everyone should buy both, right? And diversify. I think that's probably the answer. They should call both of us, spread the few million around, and diversify.
There's a forward, I think with residential, there's this idea where you have this bonus of more potential if you hit it, to hit that appreciation swing, where you say, this neighborhood is up and coming and I am going to invest at X, and in 5 to 10 years it could be 3X, because of the fact that the neighborhood made this swing from gentrification, or from this building becoming a more prized building for whatever reason, or the neighborhood changing around me. And that can happen with these residential assets in Manhattan. We've seen that over the years. And but if you don't hit it right, and you buy at the peak, and you don't buy in one of those neighborhoods that's then gonna do that, you can end up running into the other side of the equation, which would be just it kind of staying at the same value, or only appreciating, 10% or 15% over a longer time period.
And I think that's really one of the main differences. So with net lease properties, the tenant is paying taxes, maintenance, insurance. Any increase to taxes is going to be absorbed by the tenant in 99% of the cases in the leases. So you are investing in a net lease property for long-term income stability. With residential, it sounds like maybe that's not the case, but your appreciation could be greater, right? So that's just,
if you hit it right
now, do you want it stable now, or do you want to kind of roll the dice and maybe have a bigger win later?
Yes. And as you know, culturally in America, with tenants that are in residential properties, they do have high expectations of the landlord to be the one handling the repairs and improvements to the asset. And so that can be something that can be a heavy lift for some owners. And that's where having proper property management in place to be able to help with those is important, and they take their cut. And then the question is what's left for the landlord after they pay all their other carrying costs.
So true. Okay, I want to switch gears for a minute and talk about specific markets and then go into a few concrete examples of deals that you currently and I currently have listed to give some real numbers to our listeners. So touching on markets first, New York, it has so many micro markets within the broader MSA. What are some of your favorite neighborhoods right now and why? And then where do you see opportunity moving forward, if maybe it's not there yet?
Well, right now, I do believe that the neighborhoods that are struggling, that are just north of Gramercy Park, and the neighborhoods that are maybe in the West Chelsea up through Hudson Yards and up into that Hell's Kitchen area, that are probably having a little bit more inventory, because they have a ton of inventory and the demand was focused in the more prime neighborhoods. I think there's potential there to see some appreciation, and I'm excited about those neighborhoods and trying to get some deals in those neighborhoods. I also think that the heart of Chelsea has seen a tremendous downswing, because a lot of those apartments, because of what went on in New York City during quarantine, had a little bit of a tough time, with just crime in general and the way that the streets feel and look when you're walking down the streets. So I think that those areas we're going to see, some great deals, and then we're going to see appreciation there, because at some point they have to pick back up again because they are prime and they are downtown. And then the other areas I'm super excited about is going deeper into Brooklyn, where there's good architecture. There's tons of incredible neighborhoods of Brooklyn where there's great architecture and they haven't been gentrified completely yet. And, people are really going in there. Buyers are going in there. People have no problem being a little further away from Manhattan because of the fact that they're coming into the city less, but they don't want to go to the suburbs yet. And so I can see that market getting stronger and stronger over time. So those would be the areas that I am bullish about, as far as, getting some opportunities and some deals where I think things are going to continue to ramp up. And then the question is, do you believe that you just should buy an ultra prime and pay the price because it's probably discounted regardless, because everything's going to be moving up? And there's something to be said for that right now, as far as where I'm excited to see opportunities.
Thank you for sharing. It's so different with our analysis, because our clients will often look at not just immediate local markets, which we have a lot of inventory right outside Manhattan. Net lease really is, it's not a very common asset class in the city because just of the nature of the product, but within the suburbs and then within other states. So our conversations are more related to, where can we diversify, right? Should we capitalize on the movement to Florida, to Texas? Should we buy an asset there that we don't have any involvement in and diversify by actual state, and then market within the state, and then position within the market within the broader MSA? So it's an interesting thing to look at things on such a granular level, just within New York City from your perspective, and then more nationally in the movement to the Sunbelt states, and investing with a mindset that diversification can take a lot of different forms, right? Different types of assets, different areas, et cetera.
Yeah, and I'm sure for you as well, there's probably a certain amount of analysis about what's going on in those areas, that could potentially cause for appreciation or upswing, or anything that has to do with, the future of just these tenants staying in place.
Exactly. Yeah, it's a huge part of it. Not only the tenants and their business models, we look at everything from Starbucks, Walmart, CVS, really any name, any national company that you see when you drive down the street is an investment property for someone, whether it be a high net worth individual or real estate investment trust, a fund, et cetera. And there is a lot happening on a tenant by tenant basis. So we're tracking that every day, how their business models are changing, what lease terms they're offering. Do we think they're going to be opening more locations in the future? What do their prototypes look like? So there's a lot to the analysis of the actual tenant. And of course, the market's a piece of it, but I think it's a smaller piece than it is likely in your business,
Stability.
The actual location.
Right. Mm-hmm. And I think something that's probably it's a silly question for you, but something that I'm sure a lot of the people who follow me would want to understand, why did all of these, tenants rent instead of owning these assets? Why is there can you explain just on a high level what that advantage is and why they do that instead of, switching to an ownership model?
It's a great question, actually, because it seems like it would be the opposite way, right? Why would Walmart need to lease from a private investor? And it really comes down to the way those leases are handled on their books. So a lease is usually looked at as an operating expense for a business. So it becomes an expense instead of a liability. So it's all driven by accounting for the business. And actually, McDonald's used to be one of the largest landowners in the United States. Even they are becoming tenants through what we call a sale lease back, where they sell their real estate and lease it back under a long-term lease. So virtually no companies that you see when you drive down the street actually own their own real estate. It's pretty amazing. I can't think of a single one, to be honest. So everything that you see, they're in a shopping center or a freestanding building, somebody owns that, and that company and that business is renting the building from them or doing a ground lease. There's a few different structures, but they are the tenant.
Is there a certain kind of investor that's more interested in buying, say, a building with more than one tenant versus the freestanding properties?
It really goes back to risk reward. So freestanding single tenant assets with an investment grade credit corporate tenant under a long-term lease in a good location is going to be all about stability, but you're going to have a much lower yield if you're checking all of those boxes on the asset. So we have clients come to us with all different risk tolerance and ability to manage an asset, which is what you would need to do if it was multi-tenant, and then also the yield that they would be looking for. So the lower the risk, the lower the yield in most cases. So it really goes case by case on what they're looking for. But I would say lease term is a big one. Who your tenant is and what that lease looks like and how long it is, how long your income is guaranteed for is probably the biggest factor in the actual pricing and return on that asset. That's really where your value is.
Absolutely. That would make sense. I could see that being what makes the biggest difference there.
Mm-hmm. Yeah, exactly. Good question. So let's talk about some real deals. Give us a deal that you currently have listed and why it's fantastic. And I'll do the same.
Well, right now I have a couple really interesting opportunities. Specifically, one of them is in a building, Gramercy North, which is where I represent the entire building for the developer. We are marketing two bedroom plus home office homes that are 1535 square feet. They're very, investor friendly and also end user friendly. But what's really special about them is it's completely brand new construction, very low monthlies, which would be interesting to an investor. And it's that we have some really attractive priced homes that are under 2.5 million for this completely new, never been lived in asset. There is, a beautiful roof deck, which is furnished and has landscaping and a grill. So everybody can kind of enjoy this communal space that's shared by only 13 other apartments. And it's really kind of that special, great location because you're super close to everything. We're on 23rd Street next to the Freehand Hotel. And, we were just actually featured in the New York Times as, one of these really attractive buildings to, buy an investment property. And also the developers doing some really, really nice incentives right now, which is something that we're seeing kind of across the board where developers are offering, maybe a year of common charges or, not having to pay for real estate taxes. And there's all kinds of interesting ways that we're doing deals to make people, be able to feel excited about, still trying to get in on some of those last opportunities before the market tightens up completely and there's nothing left.
And I'm going to just throw this out at you, and it's kind of a tangent, but I think you can handle it. How is the financing market on these new construction deals?
It's gotten a lot better. We had a really tough moment during COVID, during the quarantine process or whatever everything was when we really were in the throes of the pandemic where, things had tightened up so much that we were having a really hard time getting the financing. This building has reached that threshold, of the percentage that we need so that we can get financing across the board with a bunch of different lenders. So, it's a good, I would say we're in a good place there. And with all of my developments across the board, they're at that at least 30%, threshold, which is what really needed to happen. It was those first deals during COVID that we had a really, really hard time, in some of these buildings getting the financing. And then they had tightened up the guidelines. And now what we're seeing is it's the appraisals are where we need to make sure that we're protected because things are moving.
Right, exactly. It's hard to keep up where the market is on appraisal sometimes, I find, both directions, up and down. It's always a wild card there. Very interesting. So I'll share a few deals that we have on market that might be interesting to the listeners, just in high level. The CBS that I mentioned, we just brought out a week and a half ago in Muncie, New York, about 30 minutes outside the city, just over $8 million deal, 4.25% return, 25-year guaranteed base term, and another 40 years of options. Very stable, long-term equity preservation play. Also brought a Chase Bank in Long Branch, New Jersey to market last week. That one is about an hour from New York City, lower price point, just over $3 million. And that's a 5.5% return, shorter term lease. We have some higher yield deals with shorter terms in New Hartford, New York, 7.5%, which is like, whoa, right? Shocking. Yeah. So remember, everything's risk reward. So that one has a smaller corporate tenant, 99 restaurants, and a 3.5-year guaranteed term, which is why the yield is so much higher. We have some other new construction deals that we'll be launching in the next week. Yields on those are going to be around 4%, 3.75, and up to mid 5. So wide range, but there is finally inventory shaking loose. Developments are being completed. Much like you, everything was on hold during COVID. The whole world shook out, right? Retail was dead was the headline. And that is, thank goodness, very, very much not true. So we're back to getting completions on new construction done.
For like another question that probably is easy for you to answer, but something I wouldn't understand. Like when you buy a property that's at a 4% cap rate, do you have any sort of idea of projections of that cap rate going up over time? And then how do you guys, how do you come up with those projections? And then do you see, any huge appreciation on these assets over time as well, in your experience, since you've been doing this for a while now?
Yeah, absolutely. So the leases are incredibly detailed. So the rent increases throughout the base term and the options. Now the options are always at the tenant's option to continue renting out the space. Landlords do not have options. So the base term and the options will include rent increases throughout the term, and that varies by deal. It might be 10% every 5 years, 7.5% every 5 years, 2% annually. There's a few different structures floating around, but that's where your net operating income increase will come from, is the rent increase from the tenant, because all of your expenses are in a true triple net deal handled by the tenant. So they're almost a non-issue. So when we're looking at your income, it matches the income from the tenant because you have no other expenses relating to the property. So there is appreciation. Cap rates vary by interest rate. So we're always looking at that spread between interest rates and cap rates. And that's how we kind of measure how compressed or not compressed the market is. Right now, interest rates are actually still very, very low. Lending has opened back up. We had that same, not freeze, but it was really tough to get retail deals done. April, May, June, let's call it a 2020. That was a little rough, but banks are back on board, and there is so much money on the sidelines right now from all different types of lending institutions who just need to get money out, that the financing terms are really, really competitive. So although our cap rates are low and we're in a compressed cap rate environment, there's still a nice spread between interest rates and cap rates. So the yield is still very attractive.
Interesting. Very, very interesting. That's just my question. Yeah, because I don't know. I don't know how that works. You buy something and then they tell you it's a cap rate, and what does that look like over the next 5 to 10 years? And then are you also buying it for this appreciation play, or is that something that,
It's all modeled out. And actually, because of the long-term nature of it, these types of assets are often used for estate planning because they're passive, and you can say, okay, in 15 years, how much rent will I be getting from this tenant? And we have a lot of people kind of in different stages of their life looking at their next generation and saying, we don't think that they want to or have the aptitude to manage real estate, for good or for bad. So we want to set up something that we know will provide this next generation with income. We know the capital will be preserved and it's going to be stable and hands-off. So that's another big kind of portion of what we do. We don't do the actual estate planning, but advising on what might be a fit.
So when we have people that come to us with looking for these higher yields, that's a place where, I can definitely refer clients to you and introduce you, you know, and that I'm assuming that starts to jump them out into, like you said, these maybe areas that are further from where we are geographically, but then also maybe, you know, a little bit more risk, but then you're getting these higher cap rates.
Exactly. And if we have someone who is more of a real estate person and they're okay, maybe redeveloping down the road, or they want to be more hands-on, that's where you get the yield, right? Like the 3.5-year deal with a 7.5% return that I mentioned, it's a higher risk deal. It's a short term. But if someone's willing to take on that risk, then the cash flow is significant for something like that. So really just depends on the investor's profile and what their goals are as to which way we would advise them, just like you. Sure.
That is very, very helpful. I would say, I mean, I'm super interested in this. I think it's been really great to just dig a little deeper in how this process works, because it's something I knew existed, but didn't really understand. And now I feel like I have a better understanding and can direct clients in your direction that are asking me for more specific kinds of, you know, assets like this, or arrangements that I can say, listen, we can't offer you that in New York City right now. And so I'm really excited. And, you know, can you tell me, I guess, let's talk about where, you know, clients can find you so that, you know, so that they can get in touch with you if they have any questions further. And then I'll do the same, because maybe they want to, you know, jump on the New York City bandwagon and see what kind of deals are left here in the city.
Absolutely. So I have a weekly video series called CRE Fast Five, which goes through the state of the net lease and commercial real estate market. It's on all the podcast channels, YouTube, LinkedIn, Instagram. Just type in CRE Fast Five and you will find me. You can go to the CBRE website, /Carly Iacono, LinkedIn, basically any platform. Type in my name, you'll find all of my contact information. And I'm happy to walk you through, if you're a new investor, kind of the ins and outs, pros and cons of this part of the commercial real estate market. So feel free to reach out on any of the platforms that you're most comfortable. And how do we find you aside from mainstream TV?
Well, I mean, I have a website, KirstenJordan.com, which takes you to either my team website, which is real estate based, or my personal site, which has a bunch of blogs and information about, you know, my thoughts on the real estate market, and also getting started as a real estate agent in Manhattan or anywhere. And then, of course, I'm on Instagram at Kirsten.Jordan. And then if you look, you can find me on the Elliman website, of course, at kjordan@elliman.com. And I am here, and I welcome any questions as well about the residential, you know, investment market in Manhattan and in Brooklyn. And we're going to be going outside of the city probably and expanding into Westchester and Greenwich, Connecticut. So we'll see what that looks like as well. I don't see that as a huge investment market for my kind of assets, but, you know, that's something that you could also speak to Carly about. So, yeah.
Excellent. Thank you so much for joining me today and providing your value on the New York City market to all of our listeners. I know it was incredibly insightful. I loved hearing about it, and I'm sure lots of people will want to continue the conversation. So thank you very, very much for your time today.
It was great talking to you. Can't wait to talk to you soon.
Absolutely. And to everyone listening, that was another episode of CRE Fast Five, a special interview edition. Thank you for tuning in. We will see you next Friday. And please reach out to both of us. We hope to continue the conversation and see you all very soon. Have a great day, everyone.